What's going on, you guys? My name is Daniel, and here on this channel, we talk about stock market investing, and we typically focus on growth stocks. However, today, we're going to be going over one of the largest deals that has happened in the Canadian telecom history. And this is Rogers is buying Shaw for $26 billion. So I'll be going over the details of the transaction and being very critical of why I think this is a very bad deal. And ultimately, I'll just tell you the TLDR, I'm not investing in Rogers or Shaw. However, there is possible upside, but we'll also talk about the risk versus reward if you're planning to buy in at Shaw. And the reason why you might consider buying Shaw for the future is the fact that Shaw prices were at $34 per share versus $40.50, which is the expected closing price of this deal if it's going through. But more on that later. If you're new here, subscribe down below and leave a like, and let's get right into the video. So the shares of Shaw Communications popped by 41.63% today, all the way to 33.85 Canadian dollars. And if we look at Shaw's share price over its entire history, it has never touched $33. At most, I think it touched around $30 per share or $31 per share in 2015. So whoever's been holding Shaw for, I guess, a while, they must have been very happy today to see the fact that the shares almost doubled. The dividend yield is still 3.5%, and the market cap is roughly around $17.35 billion. However, as a Shaw shareholder, a possibility that you could see another jump by roughly $6 from today's price, or $7, based on the price that Rogers is paying Shaw shareholders. When we look at the deal, we can see here that the total deal is $26 billion, and when we saw Shaw's market cap, it was only $17.35 billion. And scrolling further in this article, we can see that Rogers plans to purchase all outstanding Class A and Class B shares of Shaw for $45.50 per share, reflecting a 70% premium to Shaw's Class B share price. So the question is, why is Shaw's share price not yet at $40.50 when Rogers is saying that they're going to pay Shaw shareholders this price? So if you're an investor, you might be thinking, man, if I got into Shaw even today or tomorrow, it might be a pretty good deal because there still is more price appreciation all the way up to $40.50 per share. Doing some quick math on that, it looks like there's a 16.4% upside to today's price of $33.85. So the reason why people speculate that Shaw's share price didn't shoot all the way up to $40.50 is because there's still a lot of regulatory hurdles that Rogers needs to go through in order to purchase Shaw. So here we can see in this article on CBC that Shaw's shares jumped 42% to $34 on Monday, but traded well below the offering price, suggesting doubts about the deal. Now, if we go over to Reddit, we can see how people are just enraged about this entire deal. There's roughly, 277 comments. So this person's saying, increasingly competitive telecommunications market, ? Aren't most of the new small companies just offshoots from the big guys? How would this merger do anything but ensure decades more of current monopolistic landscapes of Canadian telecoms? And it goes on to say how people are just bashing this entire deal. They don't like it because essentially it's just going to be the big three again. Shaw was supposed to come in and create more competition, but clearly it's possible that Rogers could buy them out, and we're left with the only big three choices once again. Here's some other comments from Reddit. Oh, the Liberals will pass it all right. Shaw and Rogers are huge donors to Justin Trudeau. I'm not sure how true this is, but go do your due diligence, and if it is true, then the likelihood of this going through is a lot higher. Horrible news. I can already see my costs doubling. Buy your shares to cover your internet costs. A little late for that advice after they popped by 40%. Seriously, it's disgusting, and I won't be surprised at all when they let this happen. If there's one thing you can rely on the CRT to do, it's the exact opposite of their mandate. I'm with you. This is awful. I've been a loyal Shaw customer for over 18 years. I will cut the cable if they get bought out. This comment kind of takes me back. I wonder how many people will actually leave Shaw and Rogers if this deal goes through. Right now, I don't have any services with Rogers or Shaw. Currently, my internet's with Virgin and my mobile is with Public Mobile. If you want to sign up for Public Mobile, I have a link down below. Your plans will be cheaper than Chatter as well as Lucky Mobile, as they do have a $2 off auto pay option that the other two carriers don't, and all their plans are similar or exactly the same in price for what you get. Public Mobile also has a $1 off for every year that you're with them, up to a maximum discount of $5. So you can get $7 off your bill after being with Public Mobile for 5 years. There's also a bunch of comments about a complaint section that you can file. I'll have this link in the description down below if you also want to file your complaint about this merger going through. Now, if we go over this deal a little bit more carefully, we can see that Rogers will invest $6.5 billion in Western Canada to build critically needed 5G networks, connect underserved rural and Indigenous communities, and bring added choice to customers and businesses. So when I look at this statement, we can see here that they're trying to invest $6.5 billion to connect the underserved rural and Indigenous communities. That sounds more like a charity what they're doing. And I see this as an unprofitable route that Rogers is taking and investing dollars into areas like the rural or Indigenous communities where they aren't going to be able to turn a profit. Maybe they're going to get some government grants for doing this, but personally, if I'm a shareholder looking to maximize my capital, this is a red flag to me. Canada has got a lot of land, and it's going to take a lot of man hours as well as just materials to be able to build up that infrastructure to serve these rural communities as well as Indigenous communities. And the reason why Canada's cell phone bills are just absolutely atrocious is because the population density in Canada is just so low compared to other places in the world. When we look at Canada versus the US, let's just say that they're pretty much equal in amount of area, although I believe Canada is actually bigger. But US has at least 10 times the population as Canada. So therefore, the density of the population in US is 10 times of Canada, and ultimately that's why mobile companies are a lot more profitable in the States versus in Canada. There's just so much land in Canada to be able to cover and have reliable networks that it just takes a lot of money to build that out. And for that reason, that's why there's only 3 companies out there providing telecom services, because it's just got a huge barrier to entry. And it's already costing Rogers, TELUS, and Bell an arm and a leg. Another highlight about this buyout of Shaw, they say that new technology and network investments will create up to 3,000 net new jobs across Alberta, British Columbia, Manitoba, and Saskatchewan. I do believe there are going to be job cuts though across both corporations, because there's probably a lot of redundant roles across the corporations such as HR and finance and maybe even like customer service. Scrolling down further, we can see that the synergies are expected to exceed $1 billion annually within 2 years of closing, and the transaction will be significantly accretive to earnings and cash flow per share as of the first year in closing. So they're expecting to have about $1 billion in savings across the 2 corporations eventually. We can also see here Rogers' pro forma dividend payout ratio declined to below 30% within 24 months of close. So from first glance at the statement, it looks like Rogers may be cutting their dividend in order to be able to fund this Shaw acquisition. Shaw will also be the largest shareholders of Rogers, so this means that they have a lot of power in the decisions that Rogers is making going forwards. So I think from a perspective from the Shaw's family, they're probably like, of course we're going to take this deal because we are already the largest shareholder in the Shaw company. However, with Rogers, we're also going to be the largest shareholder there, and we're still going to have a lot of dominance in how the business is run. Right now, we can see that Canada's top 3 telecom operators control 89.2% of the market. And honestly, how much more can a telecom company grow in Canada? So that's really what's concerning me about this whole Rogers and Shaw acquisition. The only thing that they're really doing here is trying to cut costs across the corporations and make a more profitable corporation for shareholders. However, the amount that they're going to make it more profitable by is only $1 billion, but yet they're shelling out another $1 billion to fund this pretty useless project of connecting rural and remote Indigenous communities. So in a way, this $1 billion in savings is not really going to amount to anything to the bottom line for shareholders. Another statement in this news release, we can see the transaction will create Canada's most robust wholly owned national network, and as a result of the combined spectrum holdings and enhanced capacity, will generate more choice in competition for businesses and customers. I'm not really sure if this is actually more choice. Yes, at face value, you could have more different plans out there that suit your need. However, you're going to have to choose between three evils, whether it's Rogers, Bell, or Telus, and which one you want to support. This is definitely not the way to go in order to get a more competitive market and lower prices. But as I said earlier, it's going to be very difficult for us as Canadians to get lower prices just because of how much landmass we have in Canada. And in order to get reliable coverage almost everywhere, it takes a lot of capital to be able to build out that network. It's possible that the 5G network is probably going to bump prices in terms of like internet or mobile phone bills. But I think at the end of the day, people are still going to be very angry if they see an increase in their cell phone bill from month to month. There are going to be some benefits towards businesses though, because ultimately I think this investment into 5G is to service businesses. Businesses are always out there trying to figure out ways to save time and save money. And 5G is really just going to save them time and in a way allow them to earn more money on whatever they're selling. So potentially we could see a profit boost for all three telecom companies as 5G rolls out. But after that happens, it's just going to be another dividend paying company. And assuming there's no major disruption out there, like let's say all of a sudden we get something like Starlink, however, for mobile phones. Now closing out this video, we'll talk about when the deal is expected to close. So we can see that they're subject to the receipt of all required approvals. Likely these are approvals from the government. The closing of the transaction is expected to occur in the first half of 2022. So if you're going to go out there and buy Shaw shares tomorrow, you might not see that appreciation to $40.50 until shareholders get more confirmation that Shaw and Rogers will actually merge. So if we're looking at today, it's around March 2021, and it'll be in the first half of 2022. So you could earn roughly around 16% over a year, assuming that Rogers and Shaw do close. So the risk versus the reward of this investment is that you have a 30% downside and a 16% upside. And honestly, that's not really worth it in my opinion. Potentially the better play is to buy into Rogers if you're bullish on the telecommunications industry and think that the synergy will bring greater value to Rogers in the future. I don't mean greater value in terms of the amount of revenue that's coming in. There's no doubt that they're going to actually create more revenue across the two companies. But I mean greater value in terms of will the business of Rogers and Shaw combined create a better synergy, which they've stated it will, but ultimately will that actually play out? And if it does create a better synergy, are the other investments and promises that they've made, are those also going to add to their bottom line? If you found this video useful in breaking down what's going on with this deal and gave you a bit more insight, leave a like down below, as well as subscribe and hit that notification bell if you're new here. I've got 2 videos on the screen. If you want to check them out, I'll see you there. If not, keep up the grind and have a great day.